Yo, what is up, everyone? My name is Dom, and we're here to talk about unusual options activity. Alright, disclaimer, this video is for educational purposes only. The statements made in this programming are solely the opinion of the show and are not a specific inducement to make an investment. One must perform their own due diligence and realize all investments carry risk. There's no guarantee of profit. Okay, so first trade I want to talk about today is Shopify. Now, if you come into these February 11th calls, these calls expire in a couple days now. So we just have Thursday and we have Friday for these calls to work. Now, what I like about the unusual options activity here, first off, you can see that it's very short dated. I've been really liking these short dated trades here because when they're buying these short dated calls, they have a good idea, or at least they think the stock is going to make a move pretty much immediately. With these short-term calls, if the stock does not make a move immediately, especially for this trade, within the day you buy it or the next day, then it's probably going to trade down to a loss. So what I like about these short-term trades here is that they're buying these calls for a specific reason. They're expecting a move pretty much immediately. So if the stock does not make a move pretty much immediately within the first 1-2 days, for this trade we only have 3 days for it to work. So you got to be quick to cut your losses, but you at least know, hey, this trade isn't working. I only have a couple days left. I have to cut my losses. Instead of buying a trade, 4 months out, you could hang on to it and eventually the trade just goes to zero because you're sitting there saying, well, I have so much time. I have so much time to have this trade to work. I'm just going to hang on. To where with these short-term trades, I feel like they work out a little bit more because why is somebody going to come in and buy options that expire in 2 days, which is a pretty high risk trade? Stock has to make a move in 2 days, otherwise your options go to zero. Why would somebody come in and be buying up all those calls if they didn't think the stock was going to make a move very rapidly within that 2 days? So the people placing these trades have a high conviction that the stock is going to make a move like tomorrow. So that's why I like following these trades. These short-term trades, especially if the stock makes a move like immediately after I buy or within the same day, I try to just day trade it, especially in this environment, take my profits. But as you can see here, they're even coming in and buying the 1,000 strike call, 10,000 contracts trade, open interest 1744. Now, if we take a look at the chart here, Shopify has pulled back a massive amount here. This is a pretty expensive stock here, valuation-wise. Now, it has pulled back dramatically. It was down almost 1,000 points, peak to trough. Yeah, just a little bit less than that, 960 points or so. That does not mean that the stock is now cheap. So this is definitely a trade for me here. I wouldn't go out and buy the stock here. It does look like it might be holding some good support here. We might have bottomed around this 793 level. But these high valuation, high growth stocks, I have a lot of them in my portfolio as long-term holds. But in the short term, they could be very choppy here because they're very sensitive to interest rates. Interest rates start really spiking up here, and these stocks will take a pretty large beating here. As you can see, like Shopify did, pretty much down 1,000 points peak to trough. So, like I said, I day traded this one. I'll be keeping an eye on it tomorrow. Maybe try to get back in, do a little day trade, or just surf for the next trade. I never like to overstay my welcome in these trades. But keep an eye on Shopify, that's for sure. Next one I want to talk about is XLE. Now, these are some put trades here, and if you just scroll through all of these, the whole option chain here, you can see that there's a whole bunch of volume coming off here in the put side here. You can just scroll through and you can see here 14,000 contracts trading, 9,000 contracts trading. What I decided to do here is I went out to March and I got the 65-60 put spread. But if you keep looking here, there was a bunch of volume here in these June ones. People are buying the June 62 strike put here. That's a pretty far out of the money call here, or out of the money put. So they're expecting a pretty significant drop between now and June. If you keep going here, 29,000 contracts being traded here of the September 60 put. Now that's an extremely far out of the money put here. This ETF, the Sector Spider S&P Energy ETF, is at about 69. They're buying the 60 put. So they're expecting this ETF to be at or below 60 by September. Now that's plenty of time for this trade to work. Obviously, if this ETF trades down, $3-4 tomorrow, this trade, which is a pretty sizable move, but just as an example, if it does trade down that much, this put here is going to be, it'd probably be up 50% or something like that. But what I decided to do here is I wanted to outlay a little less premium per 100 shares that I control here. As you can see, this is a pretty far out of the money call here, but to pretty much short 100 shares of this ETF, it costs you about $300. It's that expensive for the out of the money put here because you're buying yourself a lot of time here. Just through my analysis here, I wanted to give myself a little less time, go with an out of the money vertical spread here. So some people would say it's higher risk because you're going shorter dated. I actually think it's lower risk because you're outlaying significantly less premium. I outlaid like 80 cents for the potential to have a $5 gain here. So I actually think going a little bit shorter dated here, not too short dated, a little, about a month out here, a little over a month out. I think that's actually, in my opinion, putting on a little bit less risk here, actually, and especially doing a vertical spread because I'm outlaying significantly less premium. I'm not paying for all of the time value built into the option when those people are going out to June and September here. One of the reasons I decided to go with a little bit shorter dated option here, and I went with the vertical spread so I can cut down on the time decay here, so I don't need this trade to work out immediately, because if you go out and buy a straight call, you're totally susceptible to all of the time decay. If you buy an option and then short an option in the same month, same expiry, you're losing time to time decay on the long option and you're gaining to time decay on the short option. So you don't technically need the trade to work immediately because you're not just sitting there and burning money on theta, or time decay as we call it in the options market. Now what I was saying here is one of the reasons I decided to go with a little bit of a shorter term trade here is because the XLE ETF is pretty overextended here in my opinion. You can see whenever we get overextended here in the past, like we did back in March of last year, we tend to pull back to at least the 50, the 100-day moving average. Here we're getting a little bit overextended, not really as much as in March, but we pulled back to the 200-day. Here we got a little overextended and we kind of had the moving averages catch up here. And we're pretty high above this 50-day moving average here. Moving average 50-day is at about $60. We're at about 69. So if you do that math there, 9 divided by 69, that's about 13% above the 50-day moving average, which is pretty significant. This ETF obviously has a lot of momentum, which is good, but it's pretty overbought here, and momentum indicators are not really confirming new highs here. And I think WTI crude, the futures in the oils market for March, that is starting to show a little bit of some weakness here. I'm bullish on energy actually long term, but in the short term, we put on a little bit of a short trade here because of the unusual options activity we saw. I decided to go with a little bit shorter term of trade here. So thanks to everyone who has been subscribing. Make sure to leave a like so I know to keep making more videos like this. Make sure to leave a comment down below if you got any questions just about my trade structures, or just about the analysis that I'm putting into these trades. So yeah, make sure to leave a like, leave a comment, to subscribe. We'll see you in the next one.